Hey guys, so the last couple of weeks I wrote a couple articles. One of them is called what is it called? What is money and how will blockchain change money? And the other one is on market outlook after the Fed's FOMC meeting in March, which is just a couple weeks ago. So I got some questions on these. I'm going to cover a few of those questions, but some of you told me that these videos are way too long. So I'm going to try to make them shorter and try to be more succinct, which is a challenge to me, and because I know I have the tendency to ramble. But let's see how this goes. I will try to cover this one in under half an hour, okay? So that's the challenge for today, and wish me luck in that. The first question from Adiyogi.Soul: will government stop that from happening because they want more control on economy and money supply? So this is referring to one of the point that I made is that in the What is Money article, is that once you have so many tokens on chain and you have increased liquidity because everything is on chain, it's like internet of value, everything can be interchangeable cheaply and quickly. So increased liquidity, increased financial innovation, cheap financial innovation, it will just make the credit and debt level explode even more on top of what the high level that we already see today, especially in advanced economies. And on top of that, so this person's question is why would governments allow that to happen? So this is very similar to the long-standing question that people always ask is why would government allow blockchain to happen, right? Why would government allow Bitcoin? Wouldn't they just ban it? And my short answer is I don't think so. If you look at the currencies around the world, we have about 30 currencies, 30 countries that run a fixed exchange rate. So basically their currency is pegged to some other currency, such as the US dollar or euro. Okay. And then we have about 20 countries that don't have legal tender at all. So they're just using a foreign currency as their money. And then you have another about 30 countries that runs the so-called currency board, which is just a regional agreement where you agree to have a fixed exchange rate among your neighbors. It's like a euro area is a currency board. So we're talking about over 40% of the countries in the world that already have very, very limited control over their money supply, because when you have a fixed exchange rate, you kind of you're at the mercy of the currency, of the monetary policy of the currency that you're pegged to, right? So if you're pegged to US dollar and US Federal Reserve's monetary stance is expensive, you have to follow suit because you have to maintain your peg. So that really gives countries a lot less wiggle room in terms of conducting their independently control their money supply. So what does that tell you? What it tells me is that contrary to popular perception, if there is such a popular perception, you see a good chunk of the countries in the world, they don't really care all that much about the sovereignty of monetary policy, because they're choosing to either peg their exchange rate or not have legal tender at all. So what do they care about? Countries care about stability, right? So why do you run a fixed exchange rate? The biggest benefit is stability in your trade, in your international trade activities, in your cross-border financial activities. You don't have the risk and uncertainty about exchange rate moving up and down and creating additional hassle for people who are transacting. So that is the biggest benefit, is stability. And that is the biggest concern of governments about blockchain, about financial innovation on chain. Is not because of sovereignty. It's not because it's largely not of a control or money supply concern. It's largely a financial stability concern, because the thing, because the financial regulators have so little regulation over the DeFi space and the on-chain economy at all. Unlike in the banking sector, you have a capital ratio, liquidity ratio. These regulations kind of keep in check the risk-taking behaviors of financial intermediation. On-chain, there's no regulation at all. So there is a financial stability concern with all this leveraging cycle and deleveraging cycle. The boom and bust tend to be super huge, right? Much bigger volatility than you typically would see in your traditional financial system. So that is the biggest concern for most governments. So that's why you hear more and more noises about regulation and so on and so forth, because I think really this is the biggest worry. It's not because you want to control money supply or you want to control your currency, or so that's that. And also this is why I'm optimistic, right? Because then it will take the regulators a while to figure out, okay, what kind of regulations we can put in place to make sure the thing does not it doesn't run itself to the ground and cause vast spillover to the rest of the financial system, right? And bring everything else down when the thing gets too big. But at the same time, you want to encourage financial innovation. All right. So in the meantime, if the thing grows so fast and the government really has no clue in the short term how to actually regulate the thing, maybe temporarily they will shut it down, like what China did. All right. So even the China like a crypto ban, I don't think that is a permanent thing. It's just regulators need to take a step back and study the thing and realize, okay, how and come up with a plan of how they can regulate the damn thing. So I'm very optimistic about this. So that would be my baseline. Next question from Rag K. How does this rearrange distribution of debt between poor and rich? The rich will obviously have more token, leading to higher credit rate for them compared to others. So what he's asking is, I made a point in the article that we're going to see higher credit creation, we're going to see higher debt, and we are going to see more evenly distributed debt across income levels. Because, like if you look at today, in order to borrow, like as an individual, it requires you to have collateral in order to borrow money, right? In the TradFi system. So what are typical collaterals? Real assets. Those are the most common. Your real estate, right? And if you have like a treasury securities or stocks and bonds, those are additional collaterals sometimes. But really, the real assets, real estate, is the primary collaterals of collateralized borrowing for individuals. So that means if you have assets, if you have real assets, meaning the rich people, right, then you are in a better place to borrow. If you're poor, you don't have collateral, so nobody will lend you money. In that sense, and in a low interest rate environment, as a rich person, you have collateral, you can borrow, and you can arbitrage. You can borrow cheap and invest in assets and make a lot of money. And that aggravates, income inequality, wealth inequality even more, right? So the difference here is with on-chain, even if you have, because it's divisible, right? It's not like a house. It's a one house. You have to buy the whole house. You cannot just buy, a few square meter of the house. When it's on-chain assets, it's divisible. You can have 0.00001 Ethereum or Bitcoin. That's still, you can use that as collateral to borrow some money. So in that sense, the entry barrier of borrowing is so much lower compared to in the TradFi system. I'm talking about collateralized borrowing and lending. Okay, so in that sense, it's going to tilt the distribution of debt towards the more even distribution across income levels, because the entry barrier of borrowing is so much lower. But this is not going to be a communist society, guys. This is not going to, of course, rich people have more tokens so they can borrow more. Of course, that goes without saying. But still, compared to TradFi, this is, I think, a more equal distribution. Next, Alpha A. Glad you're covering GameFi. I don't know why he's asking GameFi, talking about GameFi, because I don't remember I covered GameFi in the article, but he's saying GameFi is kind of it will allow you to weather a downturn because everybody still plays a game in economic depression, right? So Uh, so 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 that should allow I think his point is that should allow the GameFi or gaming sector to perform better even in a recessionary environment. I think this is theoretically true. Behaviorally, yes, people will play game in downturn as well. They probably play more because you have higher unemployment, and it's allow you to make some short-term cash, right? In the play to earn economies. But the thing is, in reality, all the crypto space, all the risk assets in crypto are highly correlated. Even Bitcoin and web3 tokens, they're supposed to be, two very distinct, different types of assets. One is a commodity, like a gold. The other one is like a tech stock. They theoretically very different, but in reality, token prices are all very highly correlated still. And there's barely this distinction of sectors in the crypto economy. So we're just only starting to have those because we're still so early, right? So at this stage, I don't think it's going to make that big of a difference whether you are DeFi, GameFi, gaming, NFT, whatever, or Bitcoin. When the market liquidity reduces, everything gonna tank. And when you're in the boom, everything rises. So I don't think we're there yet in terms of differentiating. Okay, like in traditional equity investing. Okay, in a downturn, I invest in maybe the secular stocks, value stocks, and in the upturn, easy money environment, I invest more in growth stocks. I think that kind of thing will come later to crypto, but we're not there yet. Next question from the Zero Particle. You missed the most important one. Luna buying BTC to back UST. Okay. So I think this is a question on the other article that I wrote last week, which is about the market condition after the FOMC meeting, right? So FOMC had another meeting middle of March, and Fed raised the interest rate 25 basis points, and market rallied, both stock and crypto afterwards. So also it's pretty much clear that at least the Federal Reserve gave the message that they're going to keep raising probably 50 basis points for each meeting going forward throughout this year at least. So that is the message that they gave, which is a much clearer message compared to what we had in December. So why did market rally after that? If you remember, if you watched some of my previous videos, a few videos before this one, I talked about, okay, we had a market sell-off in risk assets in since last quarter of last year and also this year, right? For the large part, I think because people are trying to front run the Fed, because people see monetary tightening coming, interest rate going up, liquidity going to be short. So it's in anticipation to that kind of more harsh environment, market sell-off. And there is also to some degree of financial condition tightening, like a actual tightening in the market, because we have higher inflation, we have higher commodity prices. So all those things squeeze liquidity, right? And we had the bad news of Ukraine, Russia war, increased uncertainty about global growth. That kind of all of those things is causing some degree of tightening of financial conditions already, even without actual Fed raising rates. But that tightening is it's not nearly to the extent that will justify like an over 20% sell-off of NASDAQ in, I think, a little over a month, right? So that was a very big sell-off. So that's why I said in previous videos that in large part, I think that is in anticipation of Fed actions that's going to take place in the future. However, because the market condition, liquidity conditions is actually not bad. It's not because remember we haven't tightened yet. It's just a some degree of financial condition tightening, but not a huge one. So that it's actually so I expected there will be a mean reversion event, which means like the market will rebound from this essentially deviation from the sell-off that's much bigger than the fundamental would justify. And so to me, this rally after the Fed meeting is that mean reversion, because now we have the Fed coming out with the first tightening. It's 25 basis point. Now that uncertainty is gone. Okay, so compared to December, the message is also much clearer. You anticipate Fed has several people from the Fed has said 50 basis point going forward every meeting. And in one of the future meetings, we're going to start reducing balance sheet. It could be as early as the May meeting, which is in the first week of May, I think. So that's a much clearer message, much more certainty. So to me, this is market. It's an event of a market sell the rumor and buy the news, because now you have much less uncertainty in the market now. And there's really no news on the tightening front, because you always know that the Fed is going to tighten. It's now, but now it's so much more clear what the path forward will be. So that gives the market a opportunity to bounce, provided that the underlying liquidity condition is really not bad. It's just and you have a lot of cash sitting on the sideline, even from people like me, right? So So we had a huge bounce, but keep in mind that we are going into a environment that's going to be financial conditions tighter and tighter, both from the monetary authorities like Federal Reserve's monetary policy change, and also from higher inflation, higher commodity prices. Those are going to persist for a while, right? Especially, commodity prices. So marginally, it's taking out the purchasing power of the population. And for all the investors across the board, whether you're small retail or large retail or institution, you're going to spend, for the retail investor, you're going to spend more money to buy your life essentials because of higher inflation. If you're a company, you spend more money on energy cost. So that's going to leave less of a liquidity available, disposable cash available to actually, buy the dip or actually, speculate in the financial market. So, and not to mention that we are going to have, further tightening from the monetary authorities. So that's why my baseline is I do not expect us to see a new all-time high, meaning a higher high compared to what we already had last year in the blockchain market. So but this bounce can go pretty far, but I just don't see a new all-time high, because we literally do not have. I don't think we have that momentum of new liquidity coming into the market. Okay, that's the same. We are only going to have reduced liquidity going forward. Some people say, well, the Fed cannot tighten much because they're tightening into a recession already because U.S. economy is off the peak. That may be very true. Well, that is true. U.S. economy is off the peak, and you're heading downwards, right? You're gonna hit a recession at some point. But the thing is, there is a timing issue, right? So the economy is still pretty hot. We're talking about recession eventually yet, but is it going to happen in the next 6 months? I don't think so. Maybe it's like 12 months down the road, or 9 months or 2 to 12 months down the road. Okay, so at that point, maybe you will have some kind of policy change. That will be my baseline. So, but still, meanwhile, in this 6 month window, a lot of things can happen. Market can still go down a whole lot, right? So so that would be my baseline, that this is a mean reversion event. That is the bottom line. So there are some, positive factor. Oh, and the other thing is that you have you reduced activity on chain as well. I call it the blockchain economy recession. Because if you look at on-chain activities, I posted some charts in the article. You can check it out. I'll post a link in the description. Ethereum, Bitcoin, their activity level have been going down since last, actually before June last year, they started going down. In in Q3 they recover somewhat, but still it's lower than before. Newer chains, depends on which chain you're talking about. Some of them they were seeing increasing activities like Avalanche. It was increasing till the end of last year, and then it had some level of dip. Okay, other chains, most of the other chains are doing like actually at the worst level. So my point is, you have an on-chain economy recession already. You may say this is reflexive because these activities are associated with prices. Because prices down, people lost interest. And they don't want to play on-chain anymore. When you have price going up, then people, getting busier, buying and selling assets on-chain. That is true. That is true. There is a huge factor of reflexivity in this. But what's also true is we have seen like a less and less new narratives or new innovations. Depends on your perspective. Okay. It's new innovations / narratives coming out of the web3 space. It's just because the innovation cycles, it has ebbs and flows, right? So we had a bunch of innovations 2019, 20, or even early 2021. But after that, it's all the new things coming out, it's pretty marginal because it take a while for new breakthroughs to happen. So that's just natural, right? So less of a fundamental trigger to the industry. In the past few months. Going forward, I don't see this change immediately in the next few months either. All in all, this means, as I already mentioned, what my baseline is. There are some positive factors for sure. For example, the Russia-Ukraine war makes people realize, okay, financial sovereignty is really, really important. You do not want to rely on a financial system where some government somewhere can easily politicize finance or use it as a tool to censor you or do whatever they want. So that definitely increased the awareness among the general population, right? About that the importance of financial sovereignty and the kind of tamper-proof financial system that's not being controlled by any party. So to me, this is a hugely bullish factor that's going to propel adoption of Web3 to a whole new level. Okay, I think this is much bigger bullish factor than most people realize. However, this is not an immediate factor. Adoption is going to be gradual. Okay, this is a gradual factor. While in the short term, you have the liquidity squeeze that you see coming. Okay, so it's just the time. In terms of timing, that bullish factor of long-term adoption is not gonna save the short-term volatility of the market. I don't think so. What it may do is it creates a higher floor compared to previous cycles. So maybe the prices will not drop as drastically. Maybe instead of 80%, you see 50% or 40%. Okay, so maybe it will create it will level up the floor of the volatility in the space, but it will not prevent cycle from happening. So that would be my take on the market outlook. So this person, go back to the question I just read you before. This person is saying, I missed the point of Luna buying BTC to back the UST. And what he means is this is the bullish factor that is called, driving the market up. I think this is completely hogwash. Why? Because, okay, so just to briefly, what the story is, Luna try to, beef up the stability of their stablecoin. So their plan is to sell Luna to a bunch of private investors over the counter to, use that fund to buy BTC, to use as collateral to back their stablecoin UST. So that's the story, okay? So, but you look at it, where does that money come from? Where, who are the investors that are buying those Luna, okay? In participating in the fundraise. Warren Buffett is not buying this fundraise, okay? So what I mean is people who are outside of crypto, they're not participating. It's not like people outside of crypto participating in the fundraise. Those investors that are buying the OTC Luna are insiders in crypto space already. Their liquidity is already in crypto, okay? So what is fundamentally driving the whole industry, the market cap, the whole industry is new funding coming into the space, okay? And this does not involve any new funding at all, because you have existing investors already, OG players in the space. All their liquidity is in the space, okay? So this is not new money flow into crypto. It's just a redistribution among different tokens. And on top of that, it's an OTC deal, so you're selling Luna at a discount, right? So although it's vested, right? The token is being gradually released over 4 years. So it's not like I buy the Luna over discounted on OTC and I directly flip it and sell it at a higher price. So but the thing is, essentially, I'm still buying this at a discount. Okay, so this is essentially I committed less. It took me less actual capital to buy the token than what the actual market price would require. So does that sound similar to something that to me, this is an analogy of, that's why on Twitter I said this is an analogy. You can think of it as a leveraged play. Because the same deal, when you take on leverage, what happens? You commit less capital compared to buy this asset. You committed less capital compared to what the market price would actually require you to purchase that amount of asset, right? So it's really similar to me as a leveraged play, leveraged buy, even though there's no leverage involved, but it's a discount. Okay, so to me, this is just no big change in market fundamentals at all. It's just a change in liquidity allocation among two different tokens. That's all. So I think this so-called bullish factor is a huge meme, and what is actually driving the market rebound are the factors that we have already talked about earlier. So yep. How are we doing on time? We are at 28 minutes 22 seconds right now. So not bad, Tasha. We did it. And thanks for listening. I will talk to you later. Okay, bye.